Hey everybody, my name is Justin. Today I want to bring you an article from the Motley Fool that talks about the three tech stocks that are building the future. These are fast, innovative companies that John Ballard, who wrote this article for the Motley Fool, thinks are going to do really well going out into the future. So I'm going to go over each one of these companies or why John Ballard thinks these are going to do so well. Now, I also did a valuation on each one of these companies using my discounted free cash flow model to determine what the buy price or intrinsic value of each company is. So let's start going through each one of these. So the first company on the list is Docusign. This is a company that is number one in their space for electronic signage. Docusign is significantly reducing time to complete agreements, saving companies money in the process. And they are by far the number one in their space. So Docusign's e-signature product is leader in the market. Just talked about that. Management estimates the total addressable market for its services where it generates revenue through subscriptions is approximately $50 billion. This level is far above Docusign's trailing 12-month revenue of $1.6 billion. So they're saying the market is massive going out into the future. Businesses are increasingly shifting to digital services coming out of the pandemic. Docusign reported accelerating revenue growth of 49% in fiscal 2021, while management is forecasting 40% growth this year. Spending from existing customers reached a record level in the fiscal first quarter with a dollar net retention rate reaching 125%. So these are all excellent numbers. So let's go first take a look at Yahoo Finance and see what they say as far as the growth expected for Docusign. And their ticker symbol is DOCU. So we'll go to the analyst tab here, 17 analysts following this company. And we could see here over the next 5 years, I think the company's going to grow 56%. That's unbelievable growth. This current year, they think they're going to grow 86%. Next year, 31%. All right, so now let's go take a look at my discounted free cash flow method to see what I come up with as an intrinsic value for this company. All right, so here's my model right here. So how I come up with an intrinsic value is I look at the total shares outstanding for Docusign's 194 million. I look at the trailing 12 months free cash flow, 304 million. I look at their net debt number. So basically this, even though it's a positive, they actually are in debt 236 million. So basically that's taking total short-term, long-term liabilities, subtracting out current assets. And then I am using a discounted rate. So basically it's kind of a margin of safety. And I do this for all my valuation in case analysts are off what's expected for growth. All right, so here are my growth numbers. So the first 3 years, I'm saying they're going to grow 65%. Keep in mind, analysts thought the first 5 years would be 56. So 65% the first 3 years, 50% from 4 to 6 years out, and then 40% from 7 to 10 years out. So based on that information, I believe that the intrinsic share price of Docusign is $204. So how we get to this is they're taking the free cash flow for the trailing 12 months, and we are projecting out the free cash flow based on these growth numbers here. And then we're getting to the net present value future cash flow here. So based on all of that, I think the intrinsic value market cap of this company is $39 billion. Right now it's trading at $53 billion. So right now it's not looking like a really good buy. In fact, it's about 25% less, the intrinsic value that is, than what the share price is right now. So there's obviously a lot of growth built into this company, but at this time, I personally don't think it is a good buy. All right, so let's go take a look at the next company. And that company is Roblox. So this is a pretty neat company. So basically they create this online platform, video game platform for kids, and creators, content providers can go in there and create their own games. And then kids can go in there and play them, and it's pretty unique. It's very different. I really haven't found another type of company like this out there. Roblox was founded in 2004, built the vision that the platform will one day support billions of users. Recent financial results show it's headed in that direction. Platform currently has 42 million daily active users. Users are also highly engaged on the platform, buying virtual currency called Robux to spend on additional content. This translated to revenue growth of 81% in 2020. Really impressive. Roblox is able to grow its user base quite rapidly because its platform is free to sign up. With growth accelerating during the pandemic, free cash flow also soared, reaching 518 million over the last 4 quarters. That's a healthy free cash flow margin of 22% compared to trailing books, and it provides a glimpse of how profitable Roblox could be over time. Roblox stock currently trades at a lofty valuation, so be prepared for volatility. So let's go take a look at Yahoo Finance and see what they say for analyst growth. And if you already know much about Roblox, you know what I'm going to say on this one. This was by far the most difficult to analyze, and you'll see why. So Roblox Corporation, ticker symbol RBLX. All right, so as far as analysts think, they think next 5 years is 1.1%. So I don't think that's correct. Obviously, current year, they're saying 264%. So over the next 5 years, 1% doesn't seem right, doesn't seem valid. There's only 5 people covering this company. So let's go take a look at my discounted free cash flow model and see what I come up with as far as a valuation for this company. All right, so now again, analysts don't, we're not finding anything on Yahoo Finance. So I did go out and try to read some articles and looking at what the company is projecting. And these are what I'm coming up with kind of based on the information that I saw out there. So I'm saying over the next 3 years, the company's going to grow 50%, 4 to 6 years out, 40%, 7 to 10 years out, 25%. So you might have higher numbers in this. I'm just kind of being conservative in this approach. Currently, the share price is $81, and the intrinsic share price I'm coming up with is $62 for this company. I'm thinking the intrinsic market cap is $35 billion, and it's trading at $46 billion. So at this time, it does not look like it would be a really good value from my standpoint. Based on these growth numbers. Obviously, if you think the growth numbers will be higher, that might change some things overall. So let's go take a look at the third company now and see what that is. All right, and the third company is Nvidia. It's a chip stock. In fact, it is the leading graphics card provider in the world with a commanding 81% market share. That's incredible. Of the add-in board market in the first quarter. Its chips are in most gaming PCs, and they also power every major cloud service provider. Revenue grew 84% year over year in the fiscal first quarter, that is, and profits more than double. That's incredible. Stock trades at a high forward price to sales ratio of 22. So this 84% growth is just incredible because we'll kind of see what their market cap is. I mean, they've grown considerably. So 84% is really impressive. Nvidia is also starting to license its own software platforms in addition to their chips. This is an AI stock and it's well positioned for growth. The future of computing is becoming more dependent on AI and data centers. And that's where Nvidia is positioned extremely well with its advanced chip technology. So let's go take a look at Yahoo Finance and see what they think as far as growth for this company. Nvidia is ticker symbol NVDA. And we'll go to the analyst tab here. So they think this company is going to grow 26% over the next 5 years. The past 5 years, they've grown 52%. On the surface, it seems kind of low. I'm surprised. It's still, really good growth considering a lot of companies in the market, but that does seem low based on historical numbers and how well Nvidia has performed in the past. So let's go take a look at my discounted free cash flow model and see what I come up with as far as valuation. So I'm saying the next 1 to 3 years is going to be 45%. So keep in mind, analysts thought 26% over the next 5 years. So my projections are much higher, but this is kind of based on historical growth and how well I think Nvidia is positioned in the market. 4 to 6 years out, I think 35% growth. 7 to 10 years out, 30% growth. So based on all that, I'm coming up with an intrinsic share price of $539. And right now it's trading at $745. So I'm coming with an intrinsic market cap of $336 billion, but it's trading at $464 billion. So this company too, in my opinion, and always do your own research, don't listen to someone on YouTube. This is just my valuation. But I think this company, along with the other two companies, don't look like really good buys right now. But I think a lot of it just has to do with so much growth is built into these three stocks. So if you think that, growth on any of these stocks is much higher than what I am calculating, then you have a different valuation. You may look at these companies differently. I looked at all three of these companies, and I like them all a lot, but I wouldn't buy them unless the stock price would drop to less than intrinsic values. For me, I try to buy at a 20 to 30% at least margin of safety from where the intrinsic share price is. So those are my thoughts, guys. Let me know what you think in the comment section about these. Do you think any of them are really good buys now? What do you think of my valuations? Love to hear from you guys. Thank you so much for watching. I'll catch you guys on the other side. Take care and God bless.